Hi there, Dave Keller here with Market Misbehavior. When I interview people, I love to ask them what their one chart would be. And that is, if you had one chart, just one chart, besides just a regular chart of the S&P 500, to give you a good read on the overall market environment, what would it be and why? So here's my one chart for today.
So my one chart for today is consumer discretionary versus consumer staples. And we're looking at it in two different forms here. It's one of the ways I love to look at offense versus defense in the equity space. So in the top portion, we're looking at the ratio of the XLY, the consumer discretionary sector spider versus the XLP consumer staples. And what you can see here is, the ratio is relatively flat, and actually consumer as a space, if you look at, the traditional offense within consumer discretionary, things like retail and travel, hotel, things like that. And then in consumer staples, personal products and those sorts of things, beverages, they were essentially in line. They were relatively moving in a similar pattern in the fourth quarter of last year. Sort of accelerated into the market high in February. Then you can see how the ratio really took a turn to the south as the market sold off, as people flocked towards staples, General Mills, Campbell's, sorts of things, and away from luxury goods and travel-related things, anything retail-related, really. Market bottomed out March 23rd. You can see the ratio actually bottomed out a couple days earlier, bottomed out that third week in March, started rally, put it in a higher low first week in April, and since then has continued higher. And just this week, in the last couple days, has gone to a new swing high. So it's actually gone above its February high. And if you think about it, that's actually fairly unique because the average stock has not gotten back to that point. The S&P 500 still's, sort of down here, about 61.8% of the way, retracing that February to March sell-off. So you can see the ratio in general has gone back above there, illustrating that rotation back to, sort of the traditional offense. Here's the kicker then. This is why I love this chart. The bottom panel is doing that same ratio, consumer discretionary versus consumer staples, but here we're using the equal weighted version. So RCD is an equal weighted consumer discretionary ETF. RHSN is an equal weighted consumer staples ETF. You can see that up until that March low, the ratios were actually pretty similar. So they both broke down through their most recent swing lows, although notably the equal weighted version actually broke down first. So while the cap weighted version was still above its low from January, in mid-February, this was already rolling over that third week. So you sort of got the signal from the equal weighted version first, which I found more often than not tends to happen, tends to lead it. So what's interesting right now is while the cap weighted version is to new highs for 2020, look how far down the equal weighted version is. It's still pretty far down and nowhere near its peak from the beginning of the year. This is because of the outsized weight within the consumer discretionary ETF of a couple mega cap names. Amazon's like 20-25% of the ETF. Home Depot's probably 12-13% of the ETF. So those two stocks really dramatically affect the value of the XLY, the cap weighted version. So if you look at an equal weighted version, you can think of that as looking more at the average consumer discretionary stock versus the average consumer staple stock, or as a group, as more of a level playing field. How is that group of stocks doing versus the, in consumer discretionary versus the group within consumer staples? Here you can see that while it still has been favoring consumer discretionary since the market bottom in late March, it's still nowhere near the strength that it is in the cap weighted version. So what this tells you is it's essentially been a relatively narrow story with a small number of mega cap consumer discretionary names and some mega cap consumer staples names struggling. As a result, the ratio, the performance seems pretty exaggerated to the upside. What this tells me is that there are stock picking opportunities across the board, I think, and I think that's the way in most sectors. There are opportunities to differentiate yourself as an investor by identifying some of those pockets of relative strength and underweighting the pockets of relative underperformance within most sectors. But it definitely tells me that the dominance of consumer discretionary over staples since the market bottom has essentially been driven, especially in the last 3 to 4 weeks, primarily by those mega cap consumer discretionary names. So that's my one chart for today, looking at the ratio of consumer discretionary versus consumer staples. And I'll wrap up by saying that one of the key indications I would look for is a failure of this ratio. If and when that ratio rolls over, especially the equal weighted version, I think you'll see weakness there first before you would see it in the cap weighted version. because people will flock to some of those big mega cap names like Amazon and others in a potential downturn. So I think a downturn in this ratio on the bottom panel, the equal-weighted version, is the one I'd be looking for. If this is of interest to you, check out some of my other videos on the Market Misbehavior channel. This is Dave Keller for Market Misbehavior. Have a good one.